In this session, we will look at a very important element of the short-term markets called the repo market. Repo stands for repurchase obligations. A repo agreement or a repurchase agreement is a contractual agreement whereby one party sells securities for cash at a specified price with a commitment to repurchase the same securities at a later pre-agreed date at another specified price. The difference in the two specified prices will in effect be the interest cost for the period the repo transaction is in force. Therefore, if you look at it very simply, a repo transaction effectively is a short-term interest-bearing loan backed by a collateral. A diagrammatic representation of a repo transaction will explain this concept much better. You have two parties to a repo transaction. Counterparty 1, as you will see in that diagram, who we have termed the seller, and counterparty 2, who we have termed the buyer. The seller will sell the securities or lend the securities to the buyer, and the buyer in turn will pay the equivalent amount of money for those securities to the seller. After the period of the repo is over, which could be 7 days, 14 days, the buyer will give back the securities to the seller, and in turn the seller will repay the money back to the buyer, including the interest for the period when he had borrowed the money. Repo transactions ensure that the seller, i.e. the provider of the collateral, and the buyer, i.e. the provider of cash, are able to meet their goals of liquidity with secured funding. The annualized rate of interest paid on the amount borrowed against the collateral is known as the repo rate. Repo transactions can be overnight or for a fixed term, i.e. a pre-agreed period of 7 days, 14 days, 28 days, etc. Both overnight and term repos are deliverable agreements, i.e. involve the exchange of securities and cash on both legs of the transaction, at the start and on maturity, as we saw earlier. A tri-party repo agreement, on the other hand, involves a third party such as a clearing agency or a custodian bank, popularly referred to as a collateral agent, who will act as the intermediary between the two counterparties to the repo transaction. The role of the collateral agent is to hold the securities in safe custody and facilitate the cash settlement between the two counterparties. This structure of a tripartite repo transaction is akin to the CBLO transaction, which we will study in a subsequent session. Our focus here will be on overnight and term repos. Typically, the collateral used in repo transactions are government securities, but sometimes well-rated corporate bonds are also used as collaterals in some countries. The pricing of a repo transaction is based on the term, i.e. the time period of the transaction, the quality of the collateral, the supply and demand for the specific securities being used as the collateral, and market-related factors such as the prevailing short-term interest rates and the credit risk of the counterparty. These factors are also priced into the repo transaction in the form of what we call haircuts, which will be explained in an example to follow. The overnight repo rate, as can be expected, will normally be a little lower than the overnight call money rates, or the Fed fund rates as it is called in the US, because the repo transactions are secured. They are backed by a collateral, whereas the overnight call money transactions are unsecured. Normally, only entities authorized by the monetary authority or the central bank of the country are authorized to participate in the repo market, because the repo market is at the core of the short-term liquidity management in any financial system. And two, more importantly, the value per transaction is very, very high, and therefore unforeseen issues of insolvency, etc., with any of the participants could result in a liquidity crisis in the market that could in turn result in unpredictable and devastating consequences in the near term. This is exactly what we witnessed in the 2008 financial crisis that was triggered in the United States. While in the developed economies like the United States, the repo market has a wide variety of participants, in several emerging economies like India, the repo market is used by the central bank of the country very judiciously, primarily as a tool to stabilize the short-term interest rates. This is commonly referred to as a liquidity adjustment facility. Let us see how the liquidity adjustment facility is achieved. The central bank of the country is always one of the counterparties in every repo transaction, and the other counterparty who participates in the repo market is limited to regulated commercial banks. Instruments that are traded in this repo market are almost always term repos, typically 7 days and 14 days maturity. Let's say there is a liquidity crunch in the system. The central bank at that time intervenes in the repo market, engaging in repo transactions as a cash provider, and therefore the commercial bank, who is the counterparty to the transaction, naturally becomes the security lenders, and consequently the commercial bank is the recipient of the short-term funds. And this way the central bank is able to infuse liquidity into the system. Conversely, whenever there's an excess liquidity situation in the financial system, the central bank intervenes in the repo market, this time through what is referred to as a reverse repo transaction. In other words, it's the exact opposite of a repo transaction. In a reverse repo transaction, the commercial banks become the cash providers and the central bank becomes the security lender. This way, the central bank is able to suck the excess liquidity out of the financial system. In the next video, we will look at how repo transactions are priced and how they are settled.